Welcome back to the Joseph Carlson Show. Today's going to be a busy one. We have a lot of earnings reports to review and do analysis on, and that's what this video is going to be about. We have a number of big companies, important ones that move the markets that reported their earnings yesterday and today. In particular, we're going to be going over Microsoft's earnings report. They are down 4% today. We'll be going over it. We also have VICI. They're down ever so slightly, but we're going to be looking at theirs as well. Then we have Google, going up 6%, a nice pop for Google. We'll be looking at the future of this company. Then we have Union Pacific, maybe the most surprising earnings report here, that is up 10% today on the announcement of a new CEO, Jim Vena. And we're going to go over why that CEO is so important to this company. Now, we're not stopping there. We also have Meta. Of course, they reported earnings as well. And of course, we can't forget about VICI. This company's a big holding of mine. It's one that's done really well so far. We're going to take a look at the earnings results and see how they're doing. So this is going to be a jam-packed episode where we dive in and do analysis on the latest quarter of each of these companies. Now, I want to start off, before we go into the specific earnings reports, talking about earnings in general. Every single company, I believe, is moving along a timeline, an unknowable timeline in the future. That's represented by the black horizontal line. Then we have the company's intrinsic value. This is what the company is truly worth based on its future potential and every single metric that the company has. This is the estimate that includes all the tangible things, all the physical assets the company has, as well as the intangible, the brand value, the moat, the competitive advantage, the runway of growth. All of that combined is where we estimate our intrinsic value, and that determines what we're willing to pay for a given stock. But then we also have, in green, the stock price. Even though the intrinsic value generally doesn't vary that much quarter to quarter, it can ebb and flow a little bit as there's new competitors and new developments, but over time, most companies are either growing their intrinsic value or it's shrinking. It's either ebbing and flowing, generally speaking, in one direction. The stock price, on the other hand, looks a bit more like this as a company goes along a timeline. It can go years flat, it can spike up extremely high and become overvalued. Stock prices for a single stock vary by up to 50% on average per year. There's an incredible variance of the stock price from the intrinsic value. And this can especially happen during earnings season. But our primary job as investors is to not get lost focusing on the stock price fluctuations, but rather to focus on the intrinsic value movements of a stock. So as we're looking at all these different earnings reports, that will be the focus. Now let's go ahead and start off. The first company we're going to be looking at is Microsoft. This is one that reported earnings yesterday. Large company. A lot of people believe that Microsoft is so big and so expensive that it has really no upside room in the company today. And I disagree with that. I've been a big, outspoken advocate, you could call me, an advocate for buying big tech on YouTube for a long period of time. I believe these companies are incredibly powerful with their core business models. They possess moats so strong that they're basically monopolies at a certain point. Governments try to stop these companies and they can't stop them. Consumers can't get away from their products. They use companies like Microsoft and Apple every single day, all day long. Right now, Microsoft is one of my largest holdings, a $54,000 position, and I'm currently in the green by around 11%. Let's bring up Microsoft on Qualtrim here, and this tool is available to all Patreon members. So if you want to try it out for free, just try out the Patreon. We have Microsoft, and it's trading down a little bit here. This can become scary to some novice investors. You shouldn't worry too much about the after hours or immediate trading after an earnings report. Sometimes it's indicative of what's actually happening with a company, so sometimes it's meaningful, but many times it's not. It's just trading that goes on with companies, driven largely by algorithms or people that act very emotionally. What we try to gauge always is the intrinsic value and core drivers of the company and if they're moving in the right direction. For Microsoft, there's many core drivers of this company. It's heavily diversified. So let's bring up the earnings report and see how these core operating metrics of the company are doing. Well, we can look at the revenue of the company. Is Microsoft so big, so massive that it has no growth ahead of it? Well, we look at it and the revenue has grown 10% year over year on a constant currency basis. Now, I don't know what to tell all the deniers and doubters of this company, but 10% is growth. That is solid revenue growth. Now, even on a non-constant currency basis, it grew 8%. That's solid growth for a company the size of Microsoft. In fact, that's solid growth for a company any size. A lot of smaller companies would be happy to grow 8% year over year. We also have the things that are more important than just revenue growth. Remember that revenue growth in and of itself doesn't mean much. It has to be paired with great economics. Well, the operating income of Microsoft increased by 21% constant currency. That is great operating growth of the company. The net income of the company was up 23% constant currency. Very strong growth. The diluted earnings per share were up to $2.69, a 23% constant currency increase for this stock. When I look over all of these operating metrics, what I see is a company that continues to have strong operations and is growing in every important part. And revenue and operating income, net income, and diluted earnings per share. The only thing that this leaves out is that crucial free cash flow per share metric. Now, one of the things that I've done that's helpful for Qualtrim is it automatically calculates this metric for you. For example, I can look at the free cash flow that we've calculated for Microsoft over its long history. And we even added in a lot of other metrics like putting stock-based comp next to it, the net of the free cash flow and the stock-based comp, and the adjusted free cash flow per share, which is my favorite metric. All of these are in Qualtrim, and once Microsoft's quarters put in here within 1 week, we'll be able to see these metrics illustrated here as well. But in the meantime, we can calculate this metric for ourselves by diving into the cash flow statement. There's a couple really important metrics we want to calculate to get our real free cash flow here. We want to look at the net cash from operations. This is the starting point. This is how much cash flow from operations they received. In this case, Microsoft generated $28,770 million. The next thing we do to calculate free cash flow is subtract the CapEx. Now, the CapEx usually isn't called CapEx, sometimes it is, but it will usually be called something like property and equipment, additions to, purchases of, whatever it may be. It usually includes the words property and equipment because all CapEx is a company purchasing property and equipment. So we take the $28,770 million, we subtract out the $8,943 million, and we get a $19,827 net. So that is the typical definition of free cash flow. What I like to do after I get this number is subtract out the stock-based compensation. Companies don't like you to do this. They don't want you to do this because it makes the company look not quite as profitable as it would otherwise. But in reality, if a company is diluting you through stock-based compensation, they are costing you cash. You have less ownership of the cash because you're being diluted. You're less entitled to that cash. And to calculate the impact of the dilution, we have to take out the stock-based comp for the quarter. So what we do here is we take this number and we subtract this number from it. And from that, the result I get is $17,411,000. So to compare this to Microsoft's previous quarters, we go to the adjusted free cash flow. This is the free cash flow of the company minus the stock-based comp. And we go to $17.4 billion, which would put the free cash flow number right around there. A nice step up from the year before. So Microsoft grew not only their earnings per share, not only their revenue, not only their operating income, but they also grew their free cash flow even adjusted for stock-based comp. This company is a growth company. It's a massive, highly profitable, dominant growth company. Now, investors were a little concerned about a deceleration in the cloud growth of Microsoft. They think that the cloud is basically come and gone. And a lot of investors, they're concerned that cloud is a little bit of a thing of the past, like it's going to go away. The cloud is not going away. Microsoft will continue growing the cloud for at least the next decade. My opinion, I believe the cloud is just getting started for this company. Of course, there's going to be some deceleration off of the incredibly fast growth when they barely introduced the cloud, but that should be an assumption from investors to begin with. So cloud deceleration is not something that surprises me. The other thing that investors are focusing on more now than cloud is AI. And of course, we have the Microsoft CEO saying the word AI like 60 times in the earnings report. But we also have some notable changes, real things they're doing with AI. Microsoft announced that their AI integration into all of their various product suites for businesses is going to cost a staggering $30 per person each month. Now, This is just the sticker price, and it's very expensive. It's difficult to assume that a lot of businesses are going to use this, so they're going to be offering big bulk discounts on huge corporations. So even though individually it's priced at $30 per person, they will call up a big corporation, a Fortune 500 company, and say, let's do a deal. If you sign up 10,000 seats, then we'll sell you them at a reduced price per seat. That's the type of operations Microsoft does. So even though this is $30 per person, that's not the actual price most companies will pay for it. But assuming that they offer this new feature, this new subscription, and you get millions of businesses, millions of individuals and seats sold on this, that will add meaningfully to the bottom line. Because I believe, like the rest of Microsoft's products, the AI product they're selling is going to have very high margins. So to summarize Microsoft's earnings, it grew fast in revenue, earnings per share, operating income, and free cash flow per share. The company grew in both its cloud division very quickly, and it's growing in AI and offering real tools at real prices. This company is still a growth monster. The intrinsic value of Microsoft has increased over the past 3 months. The company's worth more today than it was last quarter. So as far as I'm concerned, I'm still holding this company. I know a lot of investors will take their gains and move on to weaker companies, but I feel like I have a better chance of having substantial gains in this company if I just continue to hold. So again, if we reference this chart, Microsoft is moving up in its intrinsic value. The stock price is fluctuating, down 4% today, but the investors that stay on track with the intrinsic value will reap the rewards, as the stock price, generally speaking, will follow it over the long term. Now, the next company on the list is Visa, and although I don't own Visa, I do own a company that's highly synonymous to Visa, which is MasterCard. They both operate in that payment duopoly. Both of these companies share a huge overlap in their operational strategy, in their network effect, in their overall business. I would estimate that around 80% of their business is an overlap. They share very similar risk factors and growth profiles. Visa is an incredibly high quality compounding machine that possesses the characteristics of a company that only a few in the entire world do. There really aren't many companies like Visa. There's MasterCard. That's really the only other company that's similar to Visa. If we look at the revenue growth of the company, historically, it's very strong, around 10 to 12% per year. And that's going on for decades. Literally multiple decades, it's grown at 10%. Now, 10% growth in and of itself is impressive, but it's not the most impressive part of this company by a long shot. If we look at how they're able to convert that revenue into real economics, real profits, that's where this company becomes incredibly impressive. The free cash flow growth over the past decade is nearly 15%. 15% per year for an entire decade. Then we look at the free cash flow per share, and it's 19.6%. Almost 20% free cash flow on a per share basis over the past decade. Again, this is incredible. Try to find other companies growing that fast, especially at this scale. And one of the great parts of this company, their stock-based comp or their dilution takes up a tiny fragment of their free cash flow. That leads to free cash flow per share, even adjusted for stock-based comp, of again, nearly 20% year over year. That is such an incredible history for this company. So can this company keep up this level of growth? Is the best behind it for Visa? Let's go ahead and take a look at the report. Visa outperformed on their earnings per share, and they outperformed on their revenue estimates. In the company's financial summary, they say that they grew their revenues by 12% year over year. That's very strong growth. And they grew their non-GAAP earnings per share by 9% year over year. They'll have a high conversion rate of free cash flow. The core business of payments continues to grow overall. Payment volumes up 9%, cross-borders up 17%, processed transactions increased by 10%, the same exact rate that it's grown over the past 2 decades. So as we can see, there's something going on here with Visa. We have a situation where a company continually gets underrated by retail investors. And I continue to believe the reason why is because so many investors look at this company as a boring, washed up, old legacy business, when in reality, Visa is a cutting-edge technology company, transferring enormous amounts of data, using AI, using large networks of information, and offering SaaS products. This company is everything that investors should be looking for, but it continually gets ignored because it's not that exciting. Right now, even with these incredible metrics and 20% free cash flow growth over the past decade, Visa trades at a yield of around 4%. That is a very high yield for a company of this caliber. If I had to guess right now, my assumption on the future returns investors will receive if they buy Visa today, I believe it would be somewhere in the range of around 15% annualized. Is Visa's intrinsic value increasing quarter over quarter? Yes, it is. All the operational metrics are increasing, its total volume of customers are increasing, it still maintains pricing power, and it's offering additional services to customers. This company is a tried and true compounding machine. And although I don't own Visa directly, I look at this company's earnings because again, I believe they'll be very synonymous to MasterCard. And currently MasterCard is one of my largest holdings, a $63,000 position, currently around 5,600 in the green. Now, next up, we have Google. I'm excited to dive into this report. I've been bullish on Google for a long period of time. This is one that I hold in my growth portfolio, and it's up nearly 6% today after reporting very strong earnings, way better than expectations. But everything was right leading into Google's earnings. Everything was set up perfectly. This company traded at a reasonable, if not low valuation. The forward PE ratio is 17. The free cash flow yield is 3.7%. They do have some issues with high amounts of stock-based comp, but that's something that they can fix, something that they can improve upon. Overall, the company is a very high quality, monopolistic company that was trading at a market multiple. And there's not many times where you can get a company of this caliber trading for that price. Now, of course, we know what to expect with Google's earnings report. We expect to see the word AI mentioned many times. Right here by the introduction of the CEO, he says, "There's an exciting momentum across our products and the company, which drove strong results this quarter. Our continued leadership in AI and our excellence in engineering and innovation are driving the next evolution of search and improving all of our services. With 15 products that each serve 500 million people and 6 that serve over 2 billion each, we have so many opportunities to deliver on our mission." Just to repeat that last line there, they have 15 products serving over 500 million people and 6 of them that serve over 2 billion. The amount of scale this company has is incredible. Google has a lot of optionality in growing their earnings. And looking at the metrics, they look very strong. The revenue growth is only 7% year over year. With constant currency, it was 9%. That's basically in line with a lot of other big tech companies. We had the operating margins increasing from 28% to 29%, and we had diluted earnings per share going from $1.21 to $1.44, a 19% increase year over year. These are very strong operational metrics of the company. It shows that overall it's increasing its intrinsic value. When we look at the segment breakdown, we also see very strong growth. We see growth in overall Google search and other. YouTube ads is growing. We see the Google advertising. That's growing year over year as well. We see Google services growing. We see Google Cloud growing substantially from 6 billion to 8 billion year over year. And although they're hiring more employees, it has decelerated a little bit. They're not hiring the same huge amount they were before. And Google Cloud is posting positive operating income for the second quarter in a row, going from $590 million in the red last year to now positive $395 million. So overall, Google's results were very strong, especially for a company priced the way it is. It's priced with a lot of doubt and a lot of uncertainty, and it's outperforming those lower expectations. I still believe that this company is undervalued, and I think it will outperform the S&P 500 over the next couple of years. Now, next up, we got to talk about the most surprising earnings of the season so far, and it comes with a normally very boring, predictable company. It's one of the railroads. We have Union Pacific, a holding of mine that's $23,000, and I'm currently up $2,900. Just today, I'm up over $2,000 on this company, over 10%. Because Union Pacific just reported earnings today, and the stock is up 9.9% currently after reporting their earnings. Now, the surprising thing here is the reason the stock is moving up really has nothing to do with the previous quarter. Investors are forgetting about that. That's old news. They don't really care what happened with the previous quarter. Investors are solely focused on this big announcement. Qualtrim says that Union Pacific shares are trading higher after the company reported their Q2 financial 23 results and named Jim Vena as the new CEO. The earnings report this quarter really wasn't anything spectacular. So the reason the stock is moving up is precisely because they named Jim Vena as the CEO. So who is Jim Vena, and why are investors so excited that he's the CEO? Now, the current CEO of Union Pacific came onto CNBC to share his thoughts about this succession plan and why investors are so so excited about it.
Well, Jim is an absolutely perfect pick for us at this time, Morgan. And thank you, by the way, for hosting me this morning. You know, I started the conversation with our board about a year and a half ago on being ready for my ability to retire at the back half of this year or the front half of next year. And then to your point, at the beginning of this year, we made a stronger point on that. It would happen this year. And the board went through an exhaustive and thorough search. And in the end, they identified the individual I think is perfect for running us at this time, Jim Vena. He's got a great track record in operations in the railroad, and he has a history with us. He was our chief operating officer in 2019 and 2020 and an advisor to me in 2021.
That's the big news right there. Jim Vena is a legendary operator of railroads. And when he was the COO over the operations of Union Pacific for a short 2 years, in those 2 years, the company had better operating metrics than it's ever had in its history. The company increased all of its core metrics in a very short amount of time. And the reason the current CEO of Union Pacific is leaving is because of continued poor operational metrics of this railroad. He doesn't have a good relationship with the railroad, with the employees. There's lots of unions fighting against him. He really has a lot of bad blood between him and the employees. Union Pacific has continued to have the worst operational metrics of any Tier 1 railroad. And investors believe that Jim Vena can fix this. And in fact, investors have been pleading with Union Pacific to pick Jim Vena as the next CEO. Sorban Capital, which is a massive investor in Union Pacific that's done deep analysis on this company, feels so strongly that Jim Vena will increase equity value, increase shareholder value, that they basically wrote a letter to Union Pacific strongly urging them to pick him. They say, quote, Mr. Vena benefits from his deep knowledge of Union Pacific's culture, employees, customers, and networks. In addition, no internal candidate are remotely close as qualified as Mr. Vena, and he is a leading external candidate available. And here's what they believe the impact will be to this stock. Sorban believes that with the best-in-class leadership, Union Pacific stock has the potential to double over the next 2 years, increasing market capitalization by $67 billion. This is under a conservative scenario where the company only recaptures half the volume underperformance in comparison with its peers that Union Pacific has experienced under Fritz's tenure as CEO. This large investor in Union Pacific believes so strongly that this company can increase its value that they believe under a conservative scenario it will double over the next 2 years if they get Jim Vena. And now they have him. And of equal importance, a change in leadership will allow a healing of relationship with employees, customers, and regulators, reestablish Union Pacific's importance to the U.S. economy, and help the U.S. accelerate the transition to lower emission environment. Unlike typical shareholder engagements, which come with numerous demands, Sorban has only one ask: install new leadership who can get trains operating safely and on time. Union Pacific deserves better leadership. It is time for the board to act. That was their one big demand, and their top pick for this position was Jim Vena. So as of this most recent quarter, we could go through the metrics, but that's really not the story of Union Pacific. The story of Union Pacific right now is a dramatically underperforming Class 1 railroad that has very low valuation but massive potential. And if this new CEO is able to close that gap of operational performance from Union Pacific to its peers, there is a tremendous amount of upside in this stock. When I first bought into Union Pacific, I realized this company's one of the boring ones. There's not much news with it, not a lot of excitement, but I felt strongly it was a company that had very low downside. There's not too much more this company could go down, but it had a decent amount of upside. And I still feel that way about it now. So as of right now, I think this is great news for the company. I think the 10% move up is appropriate given this dramatic change in leadership. I'm excited to see what the CEO can do over the coming years. Now let's go ahead and move on to the two last earnings reports of this video, Meta and VICI. We'll start off with Meta. They just released earnings a few moments ago. The stock initially had a big bump, about 6%. Now it's given up about half of that. It's around 3% up right now. So this after hours number of 3% can fluctuate a lot in a very short amount of time. Now Meta beat everywhere they could on this earnings report. They beat their earnings per share estimates by analysts. They beat their revenue estimates by analysts, and they beat their expected forecast of future revenue and earnings by analysts. That is really all you can do as a company when it comes to earnings. When we look at the financial summary, we can see that the revenue here grew by 11% 12% year over year. That's very fast revenue growth, right there in line with Google, a little bit faster than Google, and right there in line with Microsoft. So Meta's showing some decent revenue growth. We have income from operations going up 12%. We have the operating margin, importantly, not collapsing. It's actually holding steady. This is another big positive for Meta. We have the net income increasing 16% and the diluted earnings per share increasing by 21%. This is a very strong report across the board. Now, when we get down to the core metrics of the company, we can also see a lot of positivity here. The daily active users have been increasing year over year, 7%. Family monthly active users are up 6%. Facebook has more daily active users, more monthly active users. Ad impressions are going up 16% year over year. There was an increase in expenses, but it was actually below their revenue. They increased expenses by 10% while increasing revenue 11%. And then their capital expenditures actually declined this quarter as well, down to $6.35 billion. Meta had been spending far upwards of $8-9 billion per quarter. They were really spending a lot in CapEx, and it seems like they're getting that under control. They also did some buybacks in the last quarter, $793 million of our Class A common stock. I think that that's a pretty low amount for the cash flow that Meta generates to buy back, but it's still good news overall. That will at least offset their dilution through stock-based comp. Now, if we're looking at the free cash flow of the company, we can do the simple calculation here. Take the net cash from operating activities. We subtract out the capital expenditures right here, and we also subtract out the share-based compensation up here. And in total, that leaves you with $7 billion, $33 million in stock-based comp adjusted free cash flow. When we look at that on the chart, it looks right around here. That's where that free cash flow line will be when Qualtrim is updated. So we can see the trends here. The free cash flow, even adjusting for the huge amount of dilution through stock-based comp, still continues to trend higher. And we're finally getting to a point with Meta where it looks like we're going to be able to surpass its historical economics, the economics it produced all throughout 2018 to 2022. So this earnings season so far for big tech has been really good. These companies continue to pull out these huge numbers and strong growth across the board. Mark Zuckerberg said, quote, "We had a good quarter. We continue to see strong engagement across our apps, and we have the most exciting roadmap I've seen in a while with Llama 2, Threads, Reels, new AI products in the pipeline, and the launch of the Quest 3 this fall." I think investors will be very happy with this report. If you're bullish on Meta before today, I think you're going to be more bullish now. Now, of course, we can't forget about VICI. This is one of the largest holdings in my portfolio. I really like VICI because of the predictable nature of the business. They simply own a lot of really extravagant real estate in Vegas, specifically on the Vegas Strip. And there's a lot of exciting things happening on the Vegas Strip. I don't know if you've heard, but Formula One is coming to the Vegas Strip. They're already doing setup, and it looks like it's going to be a crazy event. Vegas continues to be the place where experiences happen. And VICI Properties is the real estate owner of these experiences. Ed Petoniak, the CEO of the company, said, quote, "VICI's strong second quarter financial performance exemplified by approximately 36% revenue growth and nearly 12% growth in AFFO per share year over year." That is the key metric there. Revenue growth isn't quite as important for VICI. That's something that you can look at. It's exciting to have revenue growth, but really what we're looking at is the economics. How much money do we get from that revenue growth? And what we get as investors is 12% growth in the adjusted funds from operation per year, year over year. That's like a company gaining 12% net income year over year. Between that 12%, the high dividend they pay, and the capital appreciation, you're getting a very solid total return. So that is a very, very strong growth from VICI. And I believe any investor in VICI right off the bat should be happy with that level of growth. Now, Ed continues on, saying this reflects the impact of our consistent commitment to accretive acquisitions and strategic financings. We also ended the quarter with ample liquidity, including $739 million in cash and cash equivalents, $868 million in estimated equity proceeds available upon settlement of forward sales agreements, and $2.4 billion of availability under the revolving credit facility. They're trying to say there that they have a lot of liquidity. If he needs money, he can get money. The quarter results and the current liquidity enable VICI to continue in our pursuit of attractive domestic and international growth opportunities across the experiential landscape. So VICI again resembles a very predictable, reliable business with great management. Growing 12% AFFO is incredibly fast, faster than any other REIT in the market. And while VICI has this incredible growth, it's not priced for it right now. VICI remains at a very suppressed price. I'm not sure how long it's going to be at this price, but my assumption is it's not going to be forever. I believe VICI's fair value today remains around $36 per share. So I see ample upside in this stock, and this earnings report further confirms that. So that wraps up a big week so far, and we have more exciting news in the future. If you like these type of more detailed, more analytical updates on these companies, make sure to subscribe to the channel and hit the bell notification. And if you want even more content, if you really love it that much, you can also check out the Patreon. It's $10 a month. It's basically like buying one lunch a month, and I come out with hours of content on the Patreon. And the Patreon does include access to qualtrim.com as well. That's all for now. I'll see you in the next one.